Good afternoon, everybody. I'm going to ask real quick, Andy and Kayla out there, do you guys hear me? We had a little audio video problem today, but I think we got it taken care of. First of all, I just want to thank everyone that popped in here to join me this afternoon. I absolutely love doing these. And one of the things that makes it really worthwhile is if you want to ask questions, lower left on your toolbar there's a chat feature. There's nothing off limits. The point of these exercises when we do these things every single quarter is hopefully to answer the questions that you have on your mind and address the issues that you want to talk about. If all the things I got on the agenda tonight are not what you want to hear about, not what you want to talk about, please feel free to ask any questions you want. Again, nothing is off limits. So let's talk a little bit about what we do have on the agenda tonight. Well, first, we're going to take a quick look back at 2023. It definitely was not the year that a lot of people thought it was going to be in a lot of different ways. Then we're going to talk about what I think are shaping up to be two of the biggest financial stories in 2024. Of course, we're going to take a look at the stock market. We're going to take a look at the bond market and a couple other markets as well. And then I'm also going to try something a little different tonight. We're going to do something I call the Idea Lab. I read a lot of different books. I come across a lot of different things that I think might be useful for all of our clients, not only in their investing journey, but perhaps just in other areas of their life as well. So I'm going to share one of those with you. And then I'm going to open up to Q&A. Now, again, I really want to encourage you all, if you have questions as we sort of touch on all these different topics, you have questions that are not related to these topics, please feel free to ask. This is all about making sure that your questions are answered. So let's take a look back at 2023. If you take yourself back to the very end of 2022, the doom and gloom about investing in 2023 was unbelievable. I mean, I read everything from the mainline stuff. I also go and see what some of the people on YouTube are saying, and it was all uniformly negative. And my thinking back then was, if it turns out to be a bad year for investing in 2023, it's going to be absolutely the best predicted down market or bear market we have ever had. And I think this image really says it all. No one really hit the mark in terms of what people were thinking. And there's a reason for that. If you think of what it was like to be an investor in 2022, everyone's very accustomed to the stock market going up and down. It's a 20% decline in equities is pretty typical. You get one of those every 3, 4, or 5 years or so. What was different in 2022 is we had double-digit losses in the bond market for the first time that anyone's been alive. And so what that meant is for your typical balanced portfolio, 60% equities, 40% fixed income, it was a lousy time to be an investor. Average portfolio with that kind of an asset mix lost 15.8%. That ranks up there with some things that we saw during the financial crisis, the GFC in 2008. The two of those are in the Great Depression, 1937 and 1931 during the initial crash. So, even the pros suffered from something called recency bias, which is basically means that you're looking at what happened in the immediate past and you're projecting that onto the future. And so let's take a look at what people were thinking. In the beginning of 2023, leading into the year, you had several prominent financial institutions and a lot of people with pretty big followings that had pretty bad predictions about what they thought was going to occur. Not picking on any of these people because it's obviously it's a tough business for sure, but Morgan Stanley's Mike Wilson predicted a significant drop in the S&P 500. He was calling for a really big drop. Instead, the market actually climbed really significantly. Bank of America's Megan Schreiber and team advised clients to prepare for a plunge in Treasury bond yields. The exact opposite happened. Folks over at Goldman Sachs said, buy Chinese equities. They're undervalued. What occurred is Chinese equities hit new lows in the beginning of the year and continued to hit new lows throughout the year and are multi-year lows right now. Sell side consensus, this is basically people on Wall Street that are selling information, generally believed, as did a lot of people, that the U.S. was heading toward a recession. That never materialized. The economy continued to grow. Andrew Pease of Russell Investments, same. Expected a recession, didn't fare much better than was forecast. Most of the bond market predictions were saying recession, plunge in interest rates, and that none of that stuff occurred. Goldman Sachs, JP Morgan, again, we touched on that, also predicted a rebound in Chinese stocks. They hit new lows. Marko Kolanovic over at JP Morgan, he was kind of optimistic coming into the year, and then he even capitulates that 2023 is going to be lousy. The exact opposite actually was true, as all those that were invested last year shows it was actually a pretty good year. Now, one of the things I definitely want to stress is I do not have a crystal ball, and I very rarely would try to make market predictions. Pretty much every single year I'm asked the question, what do you think the stock market's going to do this year? And my answer is always pretty much the same. Those of your clients will hear this. I say at some point, we are probably going to get a 10 or 15 point pullback in the market. I say that not because I'm not brilliant or have a huge insight or a crystal ball into what the market's going to do. It's pretty typically equities at some point in any given time frame are going to pull back 12, 13, 14%. And last year was actually no different. We had about 12, 13% pullback in what was otherwise a great year leading into October before the fourth quarter was just unbelievable. So let's take a look at what I was actually saying back in January of 2023 when we did this last one a year ago. I'm hoping I'm looking through the window at my team here. I'm hoping this works because we had some audio problems, but this is actually what I said 1 year ago, and it was not a prediction, but it was a comment on the reasons that you're an investor in this economy and in this country.
There's no place on the planet that is a better place to do business than the United States, and all the competitive advantages we have done nothing but shown through, I think, more positively even over the last couple of years. So I'm extremely optimistic in terms of what will happen, the kind of innovation, the kind of things that will happen in this country over the next 5, 10 years and beyond.
So hopefully that worked. Team, did it work? Okay, we had problems with that earlier today. But here's the point. In terms of day to day, which way the financial market's going to go in 2024, I don't know. I can paint you a story that's going to be an incredibly optimistic 2024 or something incredibly negative. But what I do know is this, is here in the United States, aside from all the doom and gloom that you hear, and you're going to hear it in spades all year long because we are in a political year. This is the best place on the planet to do business. We have the most opportunity for growth. We have the most opportunity here to unleash human creativity. And one thing that you have as an investor in this country is you have an opportunity for ownership. You don't have that in other places around the world. You can own parts of the best ideas. What they do in the next 6 months, I don't know that. I'm very optimistic still, as I was a year ago, 5 years, 10 years out, 2 years, 3 years out, that innovation is going to continue. Human beings are going to come up with great ideas. People are going to buy them. The economy is going to move forward and expand. Now, what's everybody else saying going into 2024? Oops, let's go through that. Sorry about
There's
that.
no place on the planet
I had an
that is
issue
a
with that
better
anyway.
place to do business than the United States.
Hang on,
And
guys,
all the
wait a second.
competitive advantages we have done nothing but shown through, I think,
Hang
more
on, give me 1
positively
second here, guys.
even over the last couple of years. So I'm extremely optimistic.
There we go. All right. Sorry for that snafu. We had problems with that all day, but here you go. So we had the World Economic Forum was together earlier last month. And these are all of the things that we can choose to be absolutely concerned about this year. So let's just run through the list. Extreme weather, AI generated misinformation, disinformation, societal or political polarization, cost of living crisis. We've got cyber attacks, economic downturns, disrupted supply chains for critical goods and resources, escalation or outbreak of armed conflicts, tax on critical infrastructure, disrupted supply chains for food, censorship, erosion of free speech, disrupted supply chains for energy, public debt distress, skills or labor shortages, accidental or intentional nuclear events. Let's hope that one doesn't occur. Violent civil strikes and riots, accidental or intentional release of biological agents, institutional collapse in the financial sector, housing bubble burst, tech bubble burst. All that sounds actually really terrible. But here's what's kind of interesting with the exception of, I'd say, a nuclear accidental event, we've kind of experienced a lot of these things in the last 3 or 4 years. And guess what? The beat goes on every single time. However, that's not to say that everything is going to be smooth sailing. This is my idea of what the real stories are into 2024. I think there's two major stories that are going to occur this year that are going to dictate what the year looks like this year and also beyond that. So let's take a look at those right now because I think this is really the big thing. First, let's talk about inflation. And the visual I chose here, I guess, is so bad that inflation is actually going off the top of the screen. But the truth is actually something different. Inflation right now seems to be under control. So this is the inflation rates right here. What you see is on the right-hand side, we had this spike up in June of 2022. We hit a 9.1% inflation rate. And since that point, inflation has really come down. We're back at levels pretty typical to what we've seen going back to the 1970s. Even during that inflationary spike, we got nowhere near back where we were, in the late 1970s, early 1980s. Has the inflation beast been tamed? I'm not so sure of that, but I will say that everything is absolutely going in the right direction. And specifically, I want to talk about this. This chart looks like a mess, but here's what I want you to look at. Left-hand side, let's only focus on this. Everything above the line, this is things that's adding to inflation. Everything below the line is things that's taking away from inflation. What you see here, these green bars, this is energy. If you recall, it was not that long ago. We had 115, $120 a barrel oil. We're back down about 70, 75 bucks a barrel for oil right now. That's why you had basically deflationary price pressure in terms of oil. This little red bars here, these red bars. Do you remember the time where everybody was saying used car prices are like as much as new cars, if not more, because the supply chains were so messed up? Now that's deflationary. Used car prices are falling. Food at home, that rate of increase is falling. You look at restaurants remaining pretty stable. But I do want to take some time to look at this big one in the bottom here, shelter. Currently, shelter, which is basically rent, it's buying a house. This is the largest component of the CPI right now. It's more than half. So, what is happening with shelter? It's pretty critical right now to talk about how the government gathers this data. So, when they gather this data to determine what the inflation rate number is, in the shelter component, they send out a bunch of questionnaires out to people. And they say, are you paying more for your house, your rent, your mortgage, whatever it might be? But they look at 3-year rolling data basically. So if you average it out, this number is all about 18 months or so on a lag. Now, private sector in the form of Zillow, we know what these numbers look like real time. You still got in the current shelter numbers and inflation, you still got numbers back from like 2021 to 2022 before everything cooled off at the peak of kind of the housing upswing that we had during that period of time. The data that is out there presently from Zillow is showing an absolute drop in the cost of shelter. That shelter piece actually in the months moving forward could flip down to where it becomes a deflationary number in terms of moving forward. So what does that do? Why does it matter? Well, first of all, it means we're not paying as much for stuff, and that's generally we can all agree on that is a good thing. But more than that, it gives the Fed cover to at least stop raising rates, which they haven't done for a while, and maybe you even get a rate cut. Now, this is going to tie into what's going on with the Federal Reserve because there's a theme here. You've got a push and a pull that's happening right now, and you've got some big tension between the Federal Reserve, who I think is really doing the right thing, and the federal government, which is I'm just going to say not doing the right thing from a spending side. And we're going to talk about that. But monetary policy works with a lag. Okay, about 18 months it takes to really roll through the system. 18 months ago, Fed started aggressively hiking rates. What you're looking at here is this. This white line is basically the Fed rate. They raised it as fast as they ever have at any point in history. When they raise rates, generally speaking, deflationary, it sops up some of that excess money in the system. This red line, this is the Federal Reserve's balance sheet. It's going down. So what does that mean? Well, in simple way to put this is when the Federal Reserve goes and buys an assets, they buy a treasury bond, they go out and buy some kind of fixed income security. They do it with money that never existed. It's newly printed money that goes into the system. Very inflationary. When the Fed's balance sheet starts to drop, as it has, that is deflationary. What you see here in the last 20 months or so, this red line's going down on trend line. This little blip here, this is Silicon Valley Bank. When it failed, Fed juiced the system a little bit to make sure that it didn't ripple out to the rest. But the Federal Reserve is actually really doing, I think, exactly what they should be doing. I'm on Team Powell with this. I think he's done a great job. All of this, though, is working on a lag, which means you're really going to start to see the impacts of what the Fed has done, I think, in 2024 for sure. Now, I'm kind of getting at you with some wonky policy stuff here, but any questions on this? I really want to encourage anybody, if you have any questions, to please interject with that. And here's the cool thing. So it's not just the US Federal Reserve that is doing this, it's doing the right thing in terms of central bank policy. We're talking about the Federal Reserve here in gray, the Bank of Japan, the European Central Bank, and the Bank of England. Here's what's going on 2017 to 2019, pretty good years for the economy, pretty good years for the markets, pretty good years overall, all that pre 2020 stuff. And at that point, all these central banks were lower, decreasing their balance sheets. They were all kind of in like this stable to somewhat hiking posture as well. But again, not bad times. Central banks are doing what they should have done. They'd accumulated a ton on their balance sheet in the wake of the great financial crisis. They were letting this roll off. Well, what happened in 2020? I'm so sick and tired. And I'm talking about it. I don't even want to say it, but we know what happened in 2020. Every single central bank on the planet went crazy. They juiced all kinds of money into the system because they also simultaneously shut down the economies. That led to supply chain mess ups. It led to the inflationary pressures, all the stuff that we're dealing with today. This was a mistake, I think. Now, Grant, I was in the war rooms with them, and I didn't know exactly what they were talking about when they did this. But massive mistake, but they're unwinding it. At least now they're making right decisions moving forward. The only one of these major central banks that's actually still increasing their balance sheet a little bit is Bank of Japan. They kind of have to. They're in a little bit of a bind. But for the most part, European Central Bank, Bank of England, Fed doing the right thing for sure. Now, there's one major kind of counterparty to this that's not doing it. This is China. And so this is China's central bank in terms of their balance sheet, their assets. So a lot of talk about China is going to dominate the next 100 years. Will they or won't they? Who knows? But here's the thing: is their economy is in deep trouble. We've got a lot of debt. We have debt issues, which I'm going to dive into in our economy. They're concerning to me. they've got it on spades there. They've got major property developers that are failing. They're doing everything they can to juice their economy up right now. They've got empty ghost cities. They've got a lot of probably a demographic disaster that's coming on them as well. And they're responding by juicing their balance sheet, just like we did in 2020 because it's a crisis. But for the most part, every other central bank is really doing the right thing. And I think they've gotten a pretty good handle on things. So central banks doing the right thing. We're going to talk about what the government's doing on the other side because what they're doing is opposing each other. What the central banks are doing and what governments are doing are actually two completely separate things. How this gets resolved, not just for 2024, but I think moving forward is going to be probably the financial story of our lifetime, to be honest with you. Before we talk about the government, let's talk about the U.S. consumer. U.S. consumer gets a lot of heat sometimes. I don't agree with it. Look at this happy family. They're putting money in the piggy bank. They're smiling. Everything is good. And for the most part, the US consumer, largely speaking, since the financial crisis, has done the right thing. So let's take a look at that. On the left-hand side here, this is personal savings rates. All right, what you saw is pretty typically 10 to 12% from 1960 to about 1980 or so. Kind of fell off a cliff starting in 1980. But you had a lot of things really going for you. You had a bull market, a 20-year bull market in equities. You also had a 20-year bull market plus in fixed income. You had a 20-year bull market. It was the everything bull market that lasted from basically 1980 to 2000. They didn't need to save as much. But when the financial crisis came along, they found themselves in a position where they were basically had not saved enough. They couldn't meet the needs for that rainy day. And we know what happened next. But since that point, they kind of got their act together. U.S. consumer got their act together, saved quite a bit, around 5, 6, sometimes a little bit higher. Then you saw, obviously, this is COVID because the government's essentially throwing money at them. They also couldn't go out and spend any of it. So savings rates absolutely spiked. But there's a lot of talk now about savings rates going negative again. But there's something to consider here. Is first, personal saving rates are back up off the lows. I mean, when the world opened back up again, everybody decided they wanted to do everything all at once. But this, I want you to focus on this in the upper right hand side. This sort of blue amorphous blob here. This is excess saving. This is how big the stimulus was from COVID in 2020 to 2021. This is excess savings that are still in the system from COVID. We haven't even burned that off yet. You've still got about $1.1 trillion worth of excess savings on the sidelines from COVID. And let's look at the lower right hand side. This is revolving consumer credit outstanding as a percent of disposable income. All right, are we above where we were in the COVID lows, which is essentially 4% or so? Absolutely, we're at 6.3%. We are back below levels even we had post GFC from 2010 to about 2020. We're nowhere near the levels we saw from like 2000 to the great financial crisis. So, consumer credit outstanding, it's elevated, but not relative to what it has been historically. So that's something really to consider. Now, so the consumer, I think, again, has kind of done the right thing. Now, let's look at the flip side of this. And this is not a comment about any one political party. This is directed at all of them. All right, this is Congress. These people are crazy. They're spending so much money, it's ungodly. We have never seen a Congress or a government in the history of the world spend money like they are doing. And they've got to get a handle on this. Let's look at this. And here's why it's becoming so incredibly important. This chart is US federal debt that is maturing in the next 12 months. Okay. What this shows is this year we've got about $8 trillion worth of federal treasuries that are maturing this year. We're running deficits still, so it's got to get refinanced. They're running $1.5 trillion deficits too, and 2 trillion as far as the eyes can see. So they've got to find buyers for basically $9.5 to $10 trillion worth of bonds. That's a big deal. Now, what we've seen is in auctions lately, there was an auction that didn't go so hot a couple months ago. I remember reading some kind of headline like Treasury auction failure. Not even close. The coverages are still more than 2 times what they need to cover these auctions. The historical average is about 2.7 times. So if they're auctioning off a billion dollars worth of debt, there's 2.5, 2.7 billion dollars worth of bids out there. But you're getting into the mid to lower twos now, so it's changing a little bit. Buyers are not showing up with the same amount of appetite that they had in the past. But the point of this year is we've got to find buyers for about $9.5 trillion worth of Treasury debt. All right, even Chairman Powell, I honestly, this guy gets a lot of heat. I don't agree with it. I think he's done a great job. He says in an interview, it's the first time he ever said it, the U.S. is on an unsustainable fiscal path. We just are. It's starting to dig into other areas. So this is our interest payments relative to GDP. Here's what you're looking at here. We had a big run up in debt really in the 1980s. But what you saw was, and we had higher rates at that point as well, is that you had about 4.5% of the GDP of this country back around 1990, 1991 or so was directed 100% toward paying back debt. Then we got a period of time, we had phenomenal economic growth through in the 80s too, but they weren't racking up debt as much. You had the peace dividend. Remember, the curtain came down. You had also rates falling. So really from, say, 1990 to the year 2000, we got, again, it got down about 3%. And then it hit basically a floor around the great financial crisis because rates essentially went to zero. So the federal government could refi all this debt with very little interest payments. But what you're seeing now, which I think is noteworthy, is it took 20 years to get to north of 4.5% of interest payments relative to GDP back in the 60s, 70s, and the 1980s. We did it in 3 years this time. So it's the rate of change that I think is the thing that's concerning everybody. I'm throwing a lot of charts at everybody. Any questions on any of this stuff? Please don't hesitate. Next, this is another big one as well. We're spending more to finance our debt now than we are on defense. We've done this before. So here's the thing is I don't mean to frighten anybody with all this stuff because all of these places in this country, we've been here before. It's just kind of happening a little bit faster. Back in 2000, we spent more to service the debt than we did on defense. Now we're spending more to service the debt again after a long period of time, about 20 years. We're spending more on defense relative to in just pure dollar terms relative to paying interest on our debt. But here again, here's the rate of change. Bam, because you had rates essentially went from pretty close to zero to north of 5% on the short term. And this all somebody's got to buy this debt. So who's going to buy it? Well, here's the other thing that I think is pretty interesting. We've always had a lot of foreigners that have purchased our treasury debt. It's the safest asset in the world. And despite our issues and despite these scary looking charts I'm throwing at you, it still is. But back in 2008, we had about 40% of our debt was held by foreigners. That's dropping, and it's dropping really dramatically. It's about 14% now. So the point is the foreigners are not showing up to the table with the same appetite to buy US debt that they have in the past. Now, those of you that know me know I'm kind of really interested in fooling around with some of these different AI platforms. So I basically asked them, I said, all right, I said, if I put in what I think are the solutions to the debt, and I said, draw me a picture based on what you think here. And what you see is, which I think is pretty darn accurate, the AI machine's pretty smart, is it's pulling away at the foundation to build higher and higher and higher, which is kind of interesting. But what are three possible solutions? First, can significantly cut US spending. At the federal level, they can significantly cut spending. That and there are places to go. That is a place where they could absolutely go. They could significantly raise taxes. They could also monetize the debt. We're cycling back to the Federal Reserve now. What does that mean to monetize the debt? It means when the Federal Reserve, who is shrinking their balance sheet, who is kind of raising rates, who actually, in my opinion only, is doing the right thing, they undo all of that if they have to be the people that comes to purchase Treasury debt. That's monetizing the debt. If the Treasury has an auction with X number of billions of dollars worth of Treasuries and no one buys them, they will never default. The Federal Reserve will step in and buy that debt, but they would do it with newly minted money. What's probably going to happen is some combination of these three solutions is what's going to happen moving forward. And I do think how this works itself out between what the Federal Reserve is doing, which I generally agree with, and what the federal government is doing, which I don't. They just got to. We can't we can't pay for everything around the entire planet. That's got to get resolved. How it gets resolved, I think, is going to be the big story of this year and beyond. Any questions on any of that? I'm looking at a lot of participants in here today. I know somebody's got a question. Please don't hesitate. All right. So what are we doing with this? We've actually, if you notice, I've kind of always bashed metals as being an asset because it doesn't produce anything; it just sits there. But we did actually add some last year. We added a little bit of silver and gold ETF to our portfolio, so we're in that 27% of advisors that has 1 to 5% allocated toward precious metals. Will that increase in the future? Don't know, but it's just worth noting. Now let's deal specifically with the equity markets and the bond markets, just to take a look at where we're at. Again, AI generated image as well. I said, show me the stock and bond market, and this is what it had to say. All right, so question I get a lot is the S&P 500, which is kind of our broadest measure of large cap stocks. Is it expensive or not? And the answer is the index as a whole is kind of expensive relative to historical averages, but it's not crazy expensive. So what you're looking at here, when this line is up high, it's a really expensive market. When it's down low, it's relatively cheap. These imbalances can persist for really long periods of time. I mean, here, 2002 market got cheaper in 04, got cheaper in 06, got cheaper in 08. So these imbalances can persist for a long period of time. What you're finding, though, is we're pretty darn close to what the 25-year average has been in terms of the overall valuation of the S&P 500 is from a price earnings standpoint. Here's the big story, though, going back to really 2018 into 2019 or so. You got the rest of the stocks, which have kind of muddled along and generally speaking done okay. And you've got technology. So this is basically all of the different sectors that make up the S&P 500: industrials, consumer discretionary, utilities, all the way down to communication services. This blue line is tech. We've kind of seen this story before, but we've never seen it to the degree that we have this year. So that's kind of that's been the story, at least in the last, in terms of the S&P in the last year, is how much concentration, how much outperformance you've had from these big technology names. Here's another way to look at it. So this is basically index concentration. So look at this chart on the left here, and I want you to look at this green line. So when this green line goes up, the green line is the valuation of the top 10 companies in the S&P 500. When it's really high like that, it means generally speaking, they're incredibly overvalued relative to the rest of the market. This peak that we had here around 1997, 1998, this is the last tech bubble. You see the rest of the market, trading at 14 to 19 times earnings. These stocks got up to like 40 plus times earnings at that point. And then we had this period of time from like 2002 to about 2016, 2017. Value stocks, growth stocks, everything kind of traded in line. Then you got this explosion to the upside again in terms of the top heaviness of the S&P being in the biggest names in the S&P 500, meaning that take up the largest percentage of the index, basically being a lot more expensive. Like good example, this is Apple, biggest company on the entire planet. If Apple went away for some reason, the index is down by 9% because 9% of the index now is just Apple. Another thing to look at, this is the weight of the top 10 stocks in the S&P 500. So they've been more expensive in the past, but we've never had a situation where the weighting of these top 10 stocks is as big as it is right now. Basically, 10 stocks in the S&P 500 are about 32, almost 33% of the index. But here's kind of the kicker, lower right-hand side. They're not contributing as much to the earnings of the S&P. If they were 30% of the index, but they were contributing to 30% of the earnings, then it kind of balances out a little bit. 30% of the index contribute about 20% of the earnings. So by any measure, these stocks they're fairly expensive. That's not to say they can't stay expensive for a long period of time, but they definitely are more expensive now. So where does that leave us? People ask me, is the market expensive or not? I think it depends where you look. Large cap growth, which really drove performance in a lot of the portfolios last year, historically, yeah, it's expensive. Can it get more expensive? Yeah, it definitely can. Is value, and if you go down the line towards mid cap and small caps, actually historically pretty darn cheap. And I think there's a lot of value there. Another area that's really darn cheap is international stocks. And we've kind of incrementally, percent or two over the last couple of years, added into this. But all you need to really know with these two charts, if this one on the left is sloping down and to the right, this means that international stocks in developed economies are way cheaper relative to U.S. stocks, relative to U.S. stocks. And this going up and to the right on the chart to the right, that means basically that we're getting a higher yield base. You're getting paid more to wait. All right, we did get a question. How do you see this current tech bubble playing out, and how are your investment decisions impacted by that? Really, really good question. How the tech bubble actually plays out, don't know. I do think we got to exercise some restraint in terms of going completely crazy in following some of these companies. Many of these companies, we own these in a lot of portfolios, either directly or through some of the funds that we own. So there's no question we've got exposure to them. Technology is the biggest across the board, the biggest sector we are exposed to. But whereas the S&P is 30%, we're probably going to be a little closer to 20%. It's still going to be the biggest percentage of what we have. How it's going to play out, I don't know. I think at some point, valuation, it does matter. In the short term, it doesn't matter as much. In the long term, it does. A great example in these companies, they're in such dominant, amazing positions, but the amount that they need to continue to grow to justify these valuations moving forward is pretty extreme. Like sectors that are a little bit more beaten up on the value side, they don't need that much upside surprise to really get a boost in terms of those equity prices. On the tech side, they got to continue to grow at an incredible rate. Now, with everything occurring in AI, with the absolute revolution that we're going to see in that space, perhaps they will. It's why you got to own these companies. You got to participate in this. But if I knew exactly how it played out, I would be probably the only one. But it's just something that we have to continue to watch. Great question, though. So any other questions like that, please continue to chime in. Real quick on global fixed income, let's talk about this. Our rates are just higher than everyone else. Again, Powell, I think, did a pretty good job in terms of getting rates back to where they should be. And this is basically just showing you where we are relative to the rest of the world. Overnight rates about 5% here in the United States, less than 1% in Japan, 3.2% in Germany, 4.7% in the UK. Italy You give your money to the government of Italy, and they give you 3.8% versus the U.S. federal government, and they give you 5%. So, I think that there's not an imbalance between what we're paying relative to the rest of the world. Any questions on fixed income? But where do I see that? Where do I see the bond market? Kind of this is a question just popped in. Where do I see the bond market going this year? I think that kind of depends. I think the Fed is going to get cover to for sure pause. I don't think you're going to see rate hikes this year. If some of this data comes in on the real estate side specifically, where you see housing and shelter becomes not only like not very inflationary, but maybe we can get some deflation out of it. That might give them some room to cut, but we've got to figure out exactly who's going to finance a lot of this debt moving forward. So I don't think we go back to 1 to 2% inflation in the long term. My guess is we probably stay in that 3 to 5% range, and we're right there right now. So from my perspective, I'm real comfortable buying bonds out, 3, even 4 years. I don't really want to go out and buy 20-year bonds, if that makes sense. But good question. Now I'm going to try something new with everybody tonight. And my team, actually, I went through this with my team. And so if this goes absolutely terribly, then you can tell my team they were right, because they're like, Brent, I don't know if we should do this or not, but we're going to do it. We're going to see how it goes. So Idea Lab, what is this? I have a goal to either read or listen to an audiobook, a book a week. That's always been a goal of mine. Some years I hit it, some years I don't. Last year was 41 books or something. So I missed the mark. This year I'm on track to do it. But along the way, I actually read some really cool stuff. Some of it is definitely impactful in terms of that I think is worth sharing with you all, both your personal journeys or also your financial journeys. So I'm going to touch on really what I've read this year. I want to dive really deep into one book. And to the first 10 people that email me and say, I want a copy of this book, email me and I will send it to you. But first 10 that do that, I will. I'm going to get to which book it was. First book I read this year, Deliberate Discomfort, was written by a special operator, Jason Van Camp. I've actually gotten to meet this guy as well. Incredible dude. Really great book about getting through challenging times in your life. Your Leadership Legacy, another military guy, Lieutenant Colonel Oakland McCullough, also really good about leadership. Transcend Fear was the Florida Surgeon General Joseph Ladapo. Interesting read. This one was really good. Almanac of Naval Ravikant by Eric Jorgensen. Really good. Naval Ravikant is an angel investor and gives his kind of thinking on money in the world. However, I'm going to focus on one of these today. I hope you guys enjoy this. So Money Unmasked by Garrett Gunderson. That's the one we're going to kind of dive into today. So I read this book actually just last week, and I had the good fortune early in the week last week. I was at a conference where this guy spoke. All right, he looks like a hippie. He looks like he could be living in the back of your van, but he's actually delivered probably the best talk on money that I'm 50 years old. I grew up around this business that I've ever heard in my entire life. Even if you don't follow me on LinkedIn, I invite you to do so or connect with me. But I was so blown away by this guy's talk that I posted it. And I was like, just tons of wisdom that he delivered out there. He was promoting his new book. I grabbed a copy of it, so I read it on the way back. But here's a couple of things, my takeaways from this book that I think really apply to everybody. And so we're going to try a little exercise tonight. And if this goes terribly, then you can blame me and not my team, because my team said, I don't know, this could be a little confusing, Brent. But I literally got off the plane from hearing this guy speak, read his book on the plane. First client that walked in the door, I did this exercise with him. What we uncovered was actually pretty cool. So we're going to talk about something called the value index. I want you to think really quickly. We're going to go through this a lot faster than I would normally if we were sitting in the same room together. But I want you to think of what you would do if you got $10 a month, every month, for the rest of your life, tax-free, no strings attached. You know that $10 is going to come in. Would you maybe go out and get Starbucks? Would you go out and buy a magazine or something? But think about that. Most people probably aren't going to think too long about that. But what if the stakes get a little higher? What if you get $1,000 tax-free, no strings attached? $12,000 a year comes in, boom, boom, boom. Take some time, and I know this sounds weird, but really think about like what you would do. Would it be go into savings? Would it go to help a charity that you liked? Would it go towards his basic living expenses? Now think about $100,000 a month. So now we could, in the book, actually, he goes $10. He goes $100, 1,000. He basically takes up incrementally every level as you work through it. $100,000 a month tax free, $1.2 million tax free every year. What changes? What changes in that? Just take some time to think about that. If you do request a copy of the book from me, it's kind of cool how he lays it out. Now let's get a little crazy. $1 million a month, $12 million a year coming in. Now, the point of this exercise is not to think about what would happen if you had this kind of money. What it's really about, and I'm taking this directly from the book. The question is this. This is the question that matters. At what point in this exercise did you stop thinking about what you could buy or what the money could do for you, and you started thinking about value creation specifically for others? At what point did you create a vision that was rooted in value creation and focused on service? When I went through this with a client, we got, and that's the whole point, is because the whole point of this exercise is to free your brain up a little bit to think about what is important. And when I went very haphazardly and clumsily, I have to add, straight off the plane, I went through this with a client. We got down to something, Phoenix Children's Hospital, passion for kids, passion for doing things for kids. What you find out, if you can get to the bottom of that, you can win this game and then play it. You don't need whatever that number is, whether it was $1,000 a month or $1 million a month. It doesn't matter what that number is, because it uncovers the things that maybe are going to unleash your passion, totally turn you on, give you fire to do some great things. Because you know what, you don't need that kind of money to do something great. Maybe it's to write a book. You don't need to have that. You can do that on your own. What you find is when you free your brain of thinking about getting it unconstrained about finances, you start to think about things you really want to do. And what's awesome when you do that is you start to recognize that some of it doesn't take money. So it allows you to win before you even play the game. He explains it way better in his book. Again, I thought it was awesome. Second thing I uncovered, and then we'll kind of close this out from here. Four shadow personas. This may not resonate with anybody else, but it definitely resonated with me. Now, he has a quiz you can take, and I will share mine. We've got the high roller, we've got the striver, we've got the conservative, and the miser. All four of these personas have a side of them that does not help you, that causes you to make bad decisions, that causes you to miss opportunities, that causes you to miss out a lot of things on life. They also have a side of them that is actually very helpful to you. So here's this quiz, garrettgunderson.com/quiz. Anybody wants the link, I can email that to them as well. So I decided to do this. I'm like, all right, who am I? So apparently I'm the striver, which means that my negative aspects, I'm a malcontent, I'm arrogant, overachiever. I don't think that's negative. I'll take that. I like to hustle. I like that. Busy and patient. I think a lot of people probably agree with all these. But the flip side of that, the really great side, is growth, advancement, motivation, production, determination. But the cool thing is, at least what I took away from this, is when you take the time to really explore about what your relationship is with money, what you want it to do, how you want to, how you need it, obviously, to exist and survive on what is an economic planet, but also how you want to unleash it to service your goals and dreams and also the world. It's pretty cool if you realize that you've got a sub program running in the back of your brain that is either going to help you in some cases or short circuit you in other cases. So if that was interesting to people, please let me know. I thought it was fascinating. The book was awesome. Again, I'll send some copies to people that want them. But with that, I gave you some really good stuff today. 2023 was a great year. There's no question about it. We're off to a pretty good start in 2020. But this is a great quote by Napoleon Hill. Every adversity, every failure, every heartache carries with it the seed of an equivalent or greater benefit. I absolutely believe that's true. Where there's going to be problems and issues and concerns moving forward, there's definitely going to be opportunities. But it really all depends. All these financial resources that we deal with every day, they're numbers and they're incredibly important. But the most important thing about them is what it is doing to propel you forward and drive you forward in the vision for your life. And everybody's vision for their life is a little bit different. And to those of you that are on, we got a lot of you guys in here today that are clients. Thank you for allowing me to be a part of that. And we've got all right, Bruce. I see you got your hand up. Can you type in a question? Because I'm going to open this up right now to questions. Everything is on limits. There's nothing off limits, I guess, is a better way to put it. But I see we got a couple people with hands up. But if you could type questions into that chat box, that would be ideal. Susan, you've also got your hand up. Can you guys see where that is? Lower left-hand side, there should be a little box that says Q&A. If you punch into that, you can answer whatever question you would like. So while I'm waiting for you to do that, yeah, hopefully you can find that. Otherwise, while we're waiting, hopefully you guys can chime in with something. But again, moving forward into 2024, I think there's a ton of great opportunities. I think that there's going to be some hiccups every single year there is, particularly with the year that we're coming into. But I do want to give you both. You've got your hands up. If you can find that chat box, an opportunity to ask any questions that you might like. All right. Well, I'll tell you what, to both of you, I'm not sure. Annie and Kayla, can you confirm the chat box is working? I want to confirm that's working before we. Oh, here we go. It just came in. All right. Any guesses? I knew I was going to get this one. Any guesses about how the election will impact finances? Here's the gist of things. So if you look back historically, stock market tends to perform better under Republican presidential administrations. The economy tends to do better under Democratic administrations. I think that investing based on the political landscape is always kind of proven to be a mistake. Case in point, if you look at 2016, Donald Trump wins, nobody thought he won. The market crashed for about 2 hours. I remember sitting there with I was having dinner that night with a friend of mine. It was election night. We're sitting there, we're having a drink. I'm watching behind him. There's some screens up above the bar, and I'm seeing the S&P futures are dumping. They're just trashing as it looks like Trump is winning these states. My friend that I was with was not a big fan, and so we're chatting about it, and the consensus was Donald Trump wins the presidency. It's going to be a bloodbath the next day. Well, the lows were actually in election night, and then the next day the market opened up and it absolutely ripped. Conversely, Biden wins. Those that were not giant fans of him say he's going to wreck the economy. 2022 was kind of tough. This year's been pretty good. I think a lot of the bigger issues are outside the control of one specific political party or agenda. It's probably not as clear of an answer as you want, Steve, but that's the best I can do right now. Anonymous question: does Gunderson address fears about money in abundance? Yes, absolutely. If so, does he give advice on how to assuage them? The answer is also yes. I mean, we are one of the things that I mean, that book obviously loved me enough I liked it enough, I loved it enough that I wanted to share it all with you. I think so much of the financial of our finances, it's fear, greed, it's sense of self-worth. We have so much emotion that's tied to money. And a lot of it is issues that we learned when we were a kid. And we got sub programs running in the back of our head that we may not even know what they're saying. And to the degree that you can uncover those, I think is massively important, and really it takes some time to look into that, because everybody's got their own money story. Everyone's got their again, the things that their positive beliefs about finances and money, they've got their negative. I know I do for sure, and that's one of the things I really love about Gunderson's book is he dives into that. And I got to tell you, I met him after his talk. We exchanged numbers. I've been fortunate enough to kind of ping back some ideas back and forth with him since then. Dude's a great guy, and he's written a ton of books. It was his first of his books that I've read, and I'll definitely be reading more of his stuff because I thought it was really good. Another question: do you see the border crisis affect the U.S. economy? Lack of movement solutions from politicians. I'm going to take the risk of wading into this one. Yes, I do think that there's a potential impact, but I think it's unknown. The border issue, some of you that I'm seeing are not in Arizona, but we are a border state. Border issue is an absolutely huge one. I'll say it pains me to say it, but in my hometown of Phoenix here, I pass probably 200 migrants about 2 miles from my house, all in a parking lot. That's not really good because it can lead to property damage. It leads to depressed wages for people that are taking under the table wages that are hitting the lowest, the lowest income earners among us. But I think in terms of how it could impact the economy, I think you're squeezing those when you're bringing in 8, 10 million, however many we brought in, people that are operating. They're many of them are operating underneath the legal system, so the taxes are not flowing in, but yet at the same time they're getting taxpayer benefits. They're squeezing the wages of those at the lowest rungs of society. I think it creates an issue for property damage. And quite frankly, I struggle to even say it, but the 8, 10 million people here who don't know what they're doing, it could create an issue that could be big enough that could generate a lot of concern and fear. And I'll kind of leave it at that. But I think they got to do something with this. Like a country that does not defend its own. Let me put it to you in a different way. You protect the things that you love. You protect your home. You protect your family. You have barriers about who can walk into your house at night, spend that time with you and your family. I think that just being completely blunt, to not do that in this country, to not have considerations about who comes in the door, or at least at the very minimum know who they are, I think it's a problem. Maybe that's not PC. Maybe that's uh, who knows what that is, but I believe that. So I think that border crisis, I think, is going to impact the election results too this fall, but we will see. Great question. Any other questions? Any other questions? I really would love to invite you all to um, to definitely chime in here. Here's a good question about technology. Um, given the impacts of AI in the future economy, is the concentration in tech, is it justified? And the answer is that that's a really great question, because I actually read something probably about 3 or 4 months ago, where this guy is huge tech bull, and what he was saying was that based on the seismic changes that are coming to the economy, which I agree with, based on the monopoly positions that the Googles, the Apples, Microsofts that these companies have, that might even justify more of a concentration. To give you an example, the example that he uses, he looked at the size of these companies relative to countries in terms of their GDP. And they're massive. I mean, they're absolutely massive in terms of that. But more importantly, is they create these big tech companies are creating like self-perpetuating loops. All AI is running on data. And so you've got this Apple phone that you've got, and the Google search engine that you have, and Microsoft. I mean, these are the real players in the AI space. They're such a black hole sucking in all of this data. I mean, Google through YouTube and all of this that it is making these systems better and better. Their competitive advantage becomes better and better and better. And so I think that what it's going to matter from an investing standpoint is do the changes and the positive changes accrue to those companies fast enough to justify the valuations. I have no question that these changes in technology and with AI is gonna upend the world in ways that we can't even imagine yet. But the question is, are they good stocks to continue buying at these levels? The best I can give you two examples of why there's probably a need to exercise a little bit of caution. If we had sat down 25 years ago, it's 1999, and looked at the internet and we said, hey, this is a big thing. I think it's going to impact everything, and bought only internet stocks, you would have gotten blown to pieces. There were very few survivors, and most of them completely went away. So, although from an economic standpoint, from a business standpoint, it completely changed everything, most of those were lousy investments. Let's fast forward to the pandemic. We had a lot of clients that calling up and saying, hey, Zoom, it's a phenomenal platform. We're on it right now. We should be buying Zoom stock. But I looked at it at the time, it was trading like 2,000 times earnings. And it did get a little bit more expensive, by the way. But now it's actually trading at levels back below where it was trading in 2019. Because at some point, you've got to have the earnings to justify the prices that are being paid on these securities. The good news is this technology as a whole is priced nowhere near as aggressively as it was in the year 2000. So I don't think that we're there yet, but I think it's like anything, it demands a little bit of caution to really determine, to really, before you really decide you're going to go all in and increase your exposure. I mean, in our case, hard and fast rule of thumb is generally pretty good not to have more than 20% in one specific sector. We're over that now just because of what those stocks have done, and they continue to perform. But is it worth a 30%? Like it is with the S&P? I don't know. It's a little bit aggressive, but I think it's going to really depend on how quickly how quickly AI integrates itself to the point where it not just is kind of a fun tool to play around with, but where it completely changes everything and how we do business. And these companies can monetize that to the point to justify their earnings. But really good question. Any other questions? I'd really invite anybody to come in. All this stuff, there's a lot happening in the world. Come on, I went through the list of all these terrifying things that the World Economics Forum says are going to happen. But anyway, what I will do, I'm going to invite you guys again. Any last questions? If I don't get anything by the time I get done this last little piece, yeah, Andy's texting me disclosures. Good point. Thank you, Andy. I have to do this for my compliance team doesn't like me. It's just disclosures, which basically says that Raymond James does not back up or support or anything. These are my ideas and my ideas only, and I will stand by that. But I'm going to end it with this. I think that, thank you all for we had a great turnout today. Thank you all for joining me. We are going to record this as well and send it out to everybody. If you'd like to forward it, feel free to forward it to whoever you like. We also do put this up on our YouTube channel when you get the link. If you go ahead and subscribe, we put stuff up on YouTube all the time. We choose not to blast this out to our clients, but if you subscribe, you'll see whenever we load stuff up there. We also do a pretty cool podcast, and we release an episode once a week. It's on Spotify. But to everyone that joined me tonight, I really want to thank you. Having all of you, I know all these names that I'm looking at, and having you all in my life is hugely it's wonderful that we get to spend time together, not only here tonight but also in person. And I want to thank you for all your continued friendship and support. And with that, if I've piqued your interest in any of these topics specifically, please feel free to reach out to me online. And again, everybody's going to get a copy of this. And thank you all. I appreciate it. Taking one last chance for questions. All right. All right. Take care, everybody. Thank you so much.